Okay, before we head in, 17 days left to July 31st. That is the last day to buy the applied level for the all-included option. Ocean shipping will be up this week. It was supposed to be up the past week, but Thursday and Friday, the market action kept me away from things I should have been doing. So I'm going to blame the market action. It will be up this week in 4 videos, one for the sub-industry, and then you'll have one for each of Safe Bulk, one for Frontline, and one for Global Ship Lease. Following that will be 2 more, one for Clarkson's, which is a ship broker, and then one for SFL, which is engaged in dry shipping, tanker shipping, container shipping, and offshore drilling. So that is a rather interesting one. These 4 videos will be up this week. Brings up the question, what's the next sub-industry? Give me some ideas. I don't know. I'm open and flexible. I can do almost any of them. But please try to stay away from like really detailed scientific ones, like going really deep into biotech. That would take me some time, and I would have to get the help of some experts to get that done, because that is really scientific. August 25th is the last day for new positions in the market outlook. After that, it moves to the applied level exclusively. With that, let's head in. There's a lot to talk about this week. CPI, PPI, ABR, Tesla, small cap stocks, and as of yesterday, the Trump incident. Let's start with the economic data from last week, last Monday, from the U.S. consumer credit for May, increase of 11.35 billion. Now it's May, it's very backwards looking. Previous was 6.4 billion. The estimate was 10 billion, came in 11.35. 2 ways to interpret consumer credit. In a strong economy, an increase in consumer credit can be a vote for confidence, that you feel good enough about the economy and your job that you're willing to take on debt at this point in time. That is consistent with the data that we have. The other side of the story is consumers use credit as a coping mechanism. So when budgets are stretched, when prices are high and it's tough to make ends meet, they break out the credit card. That is also consistent with some of the evidence that we've been seeing out there. So, don't know which side of the fence to land on for that one. Tuesday, heading over to Mexico, inflation rate year over year, 4.98%, an increase from 4.69. The core year over year, 4.13, down from 4.15. Don't know if that is enough for the central bank to make a move at their next meeting. They are at 11%. Looking at the month over month, core rate month over month, 0.22. That's helping out. The expectation was for 0.24, still up from 0.17 though. And the headline month over month, 0.38, up from expectation of 0.24, up from negative 0.19. But that is headline core, 4.13, 0.22. Core's coming in the right way, but I don't think enough to really help the central bank. Consumer confidence coming back up to the 50 mark, 47.5. Last month was lower, but was revised higher to 46.9. Now we're at 47.5, going in the right direction. Auto production, auto exports in June up 3.3%. This is year over year. And auto production for June up 3.8% again year over year. Both down from the previous month's reading these were year over year for May. This is year over year for June. This is pretty good. You have to think about what was going on last year, where we had still constrained supply. And auto companies were not operating at full capacity because of still some lingering supply issues. That's mostly cleared up now. The auto industry, I think the annual run rate this year for sales is around 16 million. Last year was 13.8 to 14 million. And we are re-entering overcapacity, which is characteristic of the auto industry, is to operate in an environment of overcapacity. So given that, exports still positive, auto production still positive year over year, I think is a good sign. Crude stocks, if you follow oil, big drawdown. Expecting a drawdown of 3 million on crude oil stocks. The drawdown was 3.44 million, and same with gasoline stocks. Drawdown of 0.5. The drawdown was for 2 million. Moving to Thursday, this is really what changed the tone in the market for Thursday and Friday. Core inflation rate year over year, 3.3%. Previous was 3.4. The expectation was for it to be unchanged, and it came down. If we bring it to more decimal places, it was 3.277. That is core. Headline was 3%. Month before was 3.3, so that's a big drop down. The estimate was for 3.1. Looking month over month, 0.1 down from 0.2. And it's important to look at second and third decimal places, because you can get a 0.2 with a 0.151 read, and you can get 0.1 with a 0.149 read. Well, there is no difference between those two numbers really, but it would show that there's a difference, so you should calculate out. 0.163 made up the 0.2. 0.065 made up the 0.1, so you do have 0.1 in there. That's more powerful. It's not just an illusion due to rounding. Annualized, that's 0.78%, well below 2% if you take the 1 month annualized. You never really do, because lots of variability from month to month. But if this continues on, the problem is going to be the threat of deflation, not inflation. Inflation rate, the headline month over month, negative. There is deflation there, but that's mostly from food and energy. 0 down to negative 0.1. Initial jobless claims, 222,000. 239 the previous month. The estimate was 236. Continuing jobless claims, 1852, down from 1860. So 8,000 people. What happened to them? You could get this happening in two different ways. That you have a length of unemployment that you get, and some people now fall off of unemployment because they've had it long enough. They didn't get jobs. There just were no jobs for them to get, and they fell off the roll. The other explanation is some people were on unemployment and they got a job. So either they got a job or their benefits ran out, or a combination of that. PPI on Friday came in the other way, came in a lot hotter. This is PPI for final demand. There are a number of indexes. There are intermediate stages, and there's final demand. This is for final demand. It is the other side of CPI. So it's just who's standing on the other side of the cash counter. So there's the cash counter in the store. Consumers come in and give money, and that money goes to producers or whomever is receiving the money. CPI measures what the consumer, and only the consumer, pays, what comes out of their pocket. PPI measures what comes into their cash register regardless of how it came in there, which means you could have had a business come into that store and buy something. You could have had government come into that store and buy something. If you have an increase in sales tax, CPI will increase, but PPI will not, because that money does not drop into the producer's cash register. Only the price of the product goes into the cash register. The tax goes to the government. But the tax leaves the consumer's pocket, so it would place upward pressure on CPI. So we had one look at it, which is the look from the consumer's perspective, how much money is leaving their pocket. The next day we have the opposite side. Let's look at the producer. How much money are they receiving? And they're receiving it from any source, not just the consumer. So final demand is the only one that really matters. PPI month over month, the headline 0.2. Last month was negative 0.2, so that is up by 0.4 month over month. And core 0.4, last month 0.3, and was 0.2, increased to 0.3. PPI year over year 3%, up from 2.3, and that's the core, 3 up from 2.3, and year over year, 2.6 up from 2.2. This is not that important. Policy really doesn't consider PPI. Policy really considers what are consumer costs increasing by. And they look at the PCE rather than the CPI, because the PCE considers the basket of goods consumers buy. CPE is a fixed basket of goods, and the PCE has a lower weighting on the shelter component. So even though this isn't very good news overall, it's not that important. We'll look at both, not both, sorry, we don't need to look at the CPI. We'll look at PPI to see where we find these numbers, because there's a whole bunch of tables, so we'll look at it in a second, see where to find them. Then on Friday, we got Michigan consumer sentiment, 68.2, expecting some slight rebound, down to 66. And this is for July. So it's hard to, earlier in the week on Monday, we had consumer credit increase. I said there could be two reasons why. You've had consumer sentiment in the U.S. decreasing for some time. So the interpretation of consumers feel very confident about the economy and are willing to take on more credit has less truth to it, I think, or less evidence to it when we see each month when we get this reading for consumer sentiment, it keeps dropping. Let's look at the consumer expectations for July. Also dropped 69.6 down to 67.2, and this is what you expect. 67.2, and this is current, and this is just a weighting of the two. 64.1 down from 65.9, so currently it sucks. What I expect is it to get better, but still not that much better, but I do expect it to get better. That could just be the eternal optimism that we have as humans, that unless there's some real problem, we naturally just expect the future to get better. Let's have a look at the PPI report. Okay, go to table 1 in the PPI report, page 14, producer price index percent changes and weights for final demand, intermediate demand. Look for final demand under group code. FD is final demand, so we know we're looking at final demand. Read across here. This is the first one here, is the percentage change year over year, 2.6%. And there is the May to June 0.2. So we've recovered two of the numbers from the economic report that we've seen. For core, go down to the second page, and it's the second line. Final demand less food and energy, year over year 3%, month over month 0.4. Let's see if we can dive just a little bit deeper. So let's just look at final demand goods, negative 0.5. Final demand was 0.2, goods negative 0.5. If you take out the food and energy, you get the final demand for goods less food and energy is 0. So food and energy, we would expect to see negative signs in front of those, and we do see a bunch of negative signs because we started at negative 0.5, removed 2 items and got to 0. So it must have been negative 0.5 from all of the food and energy, and we do see a bunch of negative signs. 0 month over month for goods. The problem is not there. Let's go to services. Final demand for services 0.6. Now this is not goods anymore. These are services. Part of services is the service provided in bringing the goods to where they need to be and of providing the goods available. So we can think of a measure of services as the margin that wholesalers and retailers receive for the service of putting the products in place for consumers to buy. So final demand for services. If we take out trade, final demand for services trade, look at that 1.9. And you can see all the big numbers here. If we look at transportation and warehousing, negative 0.4. If you're moving people, it was expensive. If you're moving product, it was less expensive. This is the important thing. The trade. So to get a better picture, you can think of services as having a core component as well, which is taking out these variable components. So let's see if we can find final demand for services, less trade, transportation, and warehousing, 0.1. That's the more important number to look at, 0.1. And for goods, less energy and food, was 0. There you go. So how do we interpret that trade? I'll give you two examples here. Let's say in month one, we can track all the input costs to get to a final product or final service. We can track all the input costs and the final price. And let's say month over month we see no change in any of it. Then we'd have zeros across the board. The next month we see, let's say stage 1 to stage 3, we see a bunch of negative numbers, meaning the price is lower this month at each of these categories. But when we look at the price that the retailer receives or the wholesaler receives, we see the same price. So we say, well, hang on, all the inputs fell in price, but it's sold for the same price, meaning 0% inflation from, let's call it the consumer perspective. Let's say a consumer bought this, next month they come back, oh, it's the same price, there's no inflation. But there was deflation all along the input cost channel. So if you chain multiplied all of that, 1 minus 0.1 multiplied by 1 minus 0.2 multiplied by 1 minus 0.3 multiplied by 1, you'd have to have a plus to get back to 1, to get back to 100%. You'd have to have some positive number, which means margins are increasing. So wholesalers and retailers accepted the lower input costs but did nothing to their price, thereby having inflation in their trade services because their margins increase. So that's what that's measuring. But in the end, the consumer doesn't face any extra pricing pressure or very, very small. So it's the 0.1 that's more important and the 0. So when you consider PPI, final demand, which is the opposite side of the cash counter from the consumer, having 0 for goods and 0.1 for services, this is what if we think about how what the consumer is feeling, those are the two numbers that are important. Meanwhile, the wholesaler and retailer are going, man, we're doing good. Look at our margin increases, and you can see some big numbers in there for the trade category. So once you look at the numbers, you say, oh, okay, well that's not so bad. Okay, rates and yields, week over week, money market funds, well behaved. Getting out to the 6 and 1 year, they are saying, oh yes, rates are coming down, and somewhere in the next 6 months there's going to be a rate cut because it's already pricing out 11 basis points. Going out to the 1 year, pricing out 11 basis points, sitting at 4.87. Going into capital market, the 10 year is the big story here, 4.18 under 4.25, 4.18. And there is some talk last week that in the next couple of weeks, before the end of the summer, we will see a 3 handle on the 10 year. So another 19 basis points to get to that. Curve still inverted, the 2 to the 10, 27 basis points only in capital market, only the 2 to the 10 is inverted, and the money market to capital market still inverted, 125 basis points. Canada only 123, still 42 for the capital market inversion. Not much change on the balance sheet, just accumulation of some value, increase of 50 million, call it unchanged. Balance sheet increased by 2.559 billion, add the 50 million, basically an increase of 2.6 billion. Money market funds, a decrease of 10.3 billion. This is only to the 11th, so we only have the Thursday. Friday, the rally, the broader rally continued on, but we don't have that number. 10.3 billion. Retail was an increase, institution was a decrease. Both of them decreased their government exposure, and both of them increased their prime exposure. We have a light economic calendar coming up this week in the U.S. Canada has got quite a bit going on. 2 days Canadian CPI. That's going to be important for interest rate sensitive sectors like REITs. And retail sales in Canada in 5 days, retail sales in the US in 2 days, and we are now 17 days away from the July FOMC. Still really nobody betting on any move in July. Only 6.7% on a cut. Going out to December is the big move. One or no rate cuts, dropping from 23.5% down to 6.2%, implying that the weight of the probabilities are on 2 or more rate cuts. 3 rate cuts now at 51% versus 27.3%. You had 2 rate cuts last week, 47%, dropping to 39.3%. The weight shifting to more than 2. Effective federal funds rate still sitting at 5.33. Reverse repo up 15.98 billion. The TGA down 23 billion. Reserves up 18 billion. Not much to see on the balance sheet either here. Reverse repos plus reserves minus 2.5 at 40 billion a month, because that's where we are right now. 31.19 months for runoff, or at least to get to what I think is ample. 31.19 months. I'm just using 40. The question came up before of why are you using 40 when it's really higher than that. It's because MBS doesn't run off very much, only runs off at about 15 billion. But as rates come down, prepayments may increase. This may actually end up increasing closer to the 60 billion, which would bring this down to about 20 months. Real rates decreased. They are now under 2% for the 5, the 7, and the 10. Inflation expectations in the right direction, decreasing as well, consistent with CPI. Fed funds futures, fairly big move week over week. Q3, 25.5 basis points, so it's pricing in 1 cut there. Q4, 38.5, but 1.5 cuts there, so we're negative 64 versus negative 25. So your long Fed funds futures for January paid off nicely over the week. Q1, another 37 basis points, another 1.5 cuts. So over the next 3 quarters, Q3 to the end of Q1 2024, which is March 31st, 101 basis points, pricing in 4 cuts as it is. TLT had a nice week, up 1.49%. SPX 0.87%, implied volatility dropping away. There is your CPI. Big move on that one. Moving up the strikes from 89 to 90 to 90, 91 on weakness. I would sell TLT puts. A grain of salt on that statement. I am willing to sell puts at 90 to 91. It really depends on how we get there and what gets us there and what the implied volatility is. If you have a slow, nice little drop down over time and it's slow and nothing exciting, implied volatility isn't going to increase. The amount of premium for the margin that you need would be pathetic. That the ROI on that would be, this doesn't seem exciting. Sure, I feel comfortable selling puts at 90 or 91, but I'm not getting paid much to get it done. So if everyone agrees that that's a place where you would want to sell puts, all of that selling pressure would lower the premium, would keep the implied volatility low, because it would be a result of what the price is. You back out the implied volatility. So you sort of want to sell puts when nobody else wants to sell puts, because if nobody wants to sell them, the price will be high, thereby making the implied volatility high. But if everyone is sort of on board with this, saying, yeah, it's fairly safe to step in here, then there's not much of a return to make. So while I would say 90, 91 on weakness, there are competing underlyings I can sell puts on. I'm not going to tie up a whole bunch of capital on a low return put when I feel that there's a high return put somewhere else. So grain of salt on that. I think 90, 91 on weakness is a nice place. If you're in the TLT business and you want to step in anyways, I think those are nice places. If you're selling puts and you're looking for an underlying, I would evaluate the return you get on it first, the premium you're getting for the margin you have to put up, because I have not been impressed oftentimes in the last few months. I have not been impressed with the premium you get. A drop in mortgage rates, 6.89, dropped 6 basis points, but the 10-year dropped 16 basis points over that same period of time. So the spread actually increased 10 basis points. But the mortgage REITs had a good week regardless. Agency and Annaly both had good weeks. We'll talk about ABR soon. Mortgage apps for the week ending July 5th, down 0.2%. We got some data this week. NAHB Housing Market Index for July. The previous read was 43, which is contraction. Wednesday, we'll get building permits for June and housing starts for June. Speaking of housing, those housing stocks just exploded on Thursday. And I think for the interest rate sensitive sectors, I had been bullish on housing for a while. Then I was neutral. And I was asked what would it take for me to get bullish on housing again to actually start to see rate cuts. I think housing would have its next leg up. And Thursday and Friday, it took the opportunity to start pricing in some of that because what a rally in housing stocks. For investment grade, for OAS, investment grade, nothing going on there at all. In the AA and triple B, nothing. For high yield, contraction of 7 basis points. And same with double B and even triple C. Almost nothing to see here. Let's get to new positions for the Canadians out there. Enbridge. Enbridge is listed on both the Toronto Stock Exchange and the New York Stock Exchange. If you're looking to sell puts, there is no liquidity and wide spreads in the U.S. options. You have to go to the Montreal Exchange for the Canadian options. 47 put for August. I got 59 cents. I feel good about that on Enbridge. Tesla. I have more to say about Tesla because they canceled the robotaxi event or delayed it. And a very interesting story out of MIT Review, which I'll highlight. Last week I talked about the futility of trying to play Tesla on the fundamentals because it's not trading on fundamentals at all. And I'd made a case that the retail investor primarily doesn't care, nor would even read. And I think if you pulled a retail investor over and said, what are its margins? What were its sales last quarter? What's its growth year over year? I think very few would even have a clue as to what they are. And if they guessed, I think they'd be way off. So you can't play it based on the fundamentals. Its price, and we heard it on Bloomberg a number of times last week, its price is completely detached from the fundamentals. You have to play it from the psychology of the investor. So I had said, buy calls and just start telling everybody how wonderful this is and that it's going to the moon. Yeah, it's easy to say on a Sunday. Monday, the market opens. You're looking at an options chain. You got your finger on the $300 call and you're thinking, but I don't believe it. I don't believe it. I can't do what I don't believe. So I switched from that to saying, I'm just going to buy puts. That's all. So I have a $250 put. I opened this up Friday for January 2025. When you sell short periods of time. When you buy long periods of time. Paid $36.50. My thinking is I'm willing to lose up to $50,000, and that's it. I got super lucky last week. Man, did I get lucky, and I'll explain how I got lucky on both ABR and Tesla. I'll explain Tesla shortly because I did buy puts on Tesla on Thursday. Closed them and then reopened some puts for Friday. The universe, I think, felt bad about what it did to me over the last couple of years and threw me a couple of nice winners because I got lucky, really lucky, and I'll explain that. I also bought a put on ES. Puts, 56.75 puts for September with the September contract as the underlying. September 20th has two expirations, a September contract and a December contract. Make sure you get it right. Make sure if you're doing the September 20th, it's a September underlying. 56.75. I paid 101 for that. So each one is 5,000 and some odd dollars. Again, I'm willing to lose up to 50,000 on that one. Taking on delta or negative delta that changes for ES and for Tesla has well, not that it hasn't worked out. If you give it enough time, it works out. It's just uncomfortable because if you sell puts, sorry, not sell puts. If you sell calls, as the market goes up, it hurts more and more and more. But if you buy puts as the market goes up, it hurts less and less. You can sleep at night because you've already upfront agreed to the maximum you're going to lose. So I've done those. With Tesla, it's twofold. Number one is they are detached from fundamentals, but I'm just not going to take on negative delta on a short. I'd rather take on negative delta on a long position, which is the 250. And it's the slow realization that I think will take over as the months roll out, that all of the data that the Tesla shareholders are so proud of, that the Tesla has the best data and the most data. All of that data has a value, a future value of 0. I'll explain that when I talk, when I show you the MIT story. I'm also long the US CAD pair, 136.05. I think Canada is in much worse shape than the US. I think Canada is going to cut a lot faster than the US will, even though the US looks like they're going to cut. That gives the green light for Canada to cut, because there was some concern about how wide the interest rate differential could get. And Meldrum did acknowledge that there was some thought or some consideration to how wide the interest rate differential could get, meaning Canada cannot just keep cutting rates while the US doesn't, because that differential will get wider and wider, and a lower currency might be inflationary to Canada. We have permission, it seems, from the US for the Bank of Canada to cut, because the worry about the inflation interest rate differential isn't going to be as strong. So I think they're going to cut again, which would make the Canadian weaker, not stronger, in the short run. So I went long the US, short the CAD at 136.05. Two reasons. I do think this finds its way to 138, 139. At 139, I think I would want to go the other way. But I needed to cover a short US dollar position. And the cheapest way to cover a US short dollar position is wholesale funding. Wholesale funding is the currency market. You can do it yourself. You don't actually have to borrow money. You can just come up with as many dollars as you want by entering a currency market in which you think, I'll get US dollars, but the US will strengthen against that currency. Thank you very much. I've had no change in REITs, even though the REITs had a good week. CapREIT, Minto, Interrent, Killam, doing well. CapREIT, I think, doing the best of them. 47 and change, depending on how CPI goes. If CPI gives the market the ability to give the Bank of Canada permission to cut, I think CapREIT could probably find its way to $49, $50. And as far as all the puts that I sold, I'm holding all the puts. I have no gamma risk at all because the market has moved significantly. All my puts are, I mean, if I tried to close them, that'd be a nickel to 6 cents to 7 cents. And I think, but why? Why spend all of the money per contract? Because there are hundreds of contracts. Why spend the money to close them? I got 1 week left and I got no gamma risk. So I'm holding all my puts. ABR, let's talk about that one. You remember that I was short the $14 calls for July at $1.65. I'm also short the $13 puts for October at $1.75. So as ABR was increasing through here, It was taking away all of the gains I had on the 14 calls, but handing the gains over to the $13 put. On Thursday night, I got assigned. I had 130 of these, and I wasn't going to close them. I thought, well, I'll just wait because almost all the gain had disappeared, and I thought, well, I'll wait till Friday and I'll make a decision. Do I want to roll them over into the next month or just say, okay, well, I didn't make anything on them. Good enough. I got assigned overnight, 27 of them. So going into Friday morning, I was short 2,700 ABR and had 103 calls. And then Friday started, and I thought, well, I'll close the 2,700 if I can get them for 14 or 15.65. That means I lose nothing on that, and then I'll see what I want to do on the calls. So it was 9:45. Looking at the market. Looking at ABR, it had strength in the morning. You could see the top part of the bar here. It was pushing up 1580, and I thought, well, I'm going to have to take a loss. Let me think about this. I had an eye appointment at Costco at 10 o'clock. I went to my eye appointment, got my new prescription, ordered my new glasses, came home, looked at the screen. I saw that it was still green. Doing some other things, I look over, I see it again. I see a negative sign and it's red, and I think, okay, well, great. So I get my mouse and my keyboard, I move my hands to that, I look back up, now it's down 50 cents, then 70 cents, then 90 cents, then $1, and I'm thinking, what the hell is going on? It's just dropping like crazy, and I needed to cover this off that day. I ended up covering this off at 14.155 was my average cost in covering those off, and I was willing to take a loss. And these were assigned to me at 14. So this is the same as closing those puts at 15 cents, which is what I was trying to do before, is to close them at 15. I didn't get them. And then I had the 103 calls, and I thought, well, I'll close them at 15 cents. But volatility had spiked. So there was still a lot of premium in them. By the end of the day, I could have closed them for 10 cents. But ABR finished at 12.88, and I got 1 week left to go. And I thought, nah. Why spend the money on closing them now? I'll keep them. So I got super lucky that day. This thing here was like, thank you very much. It got me out of this, and it handed me a profit over there. And since volatility spiked on my 13 puts for October, they were pretty much back at 175. So I lost all of the gain I had on that, which is okay. What do we make of this? You have a Department of Justice FBI investigation. This is not as surprising. When I saw it, I thought, well, that's not as surprising as I thought. We're going to look at a story that was in the Wall Street Journal a few days before, and that might calm you down a bit. This is the statement coming out of ABR. We routinely cooperate with regulatory inquiries and are very confident that we conduct ourselves properly. We look forward to our second quarter earnings call. They're not going to say much more than this. I don't expect us to get much. I think that the majority of it will come in their earnings call. I would be watching for any new Form 4s. They cannot sell. My God, they cannot sell. Remember with the short attacks, you had a bunch of insiders buying stock. They were just buying. If anything in those short attacks were true, it'd be hard to think about why they would be buying in the face of all that. I mean, when you go back to Enron, the insiders were not buying. Even though they were being accused of things and the accusations were starting, they defended themselves, but they were not buying, they were selling. The insiders from ABR were buying. What I'm looking for in the new Form 4 is not a D, meaning disposal. I'm looking for an A. I'm looking for an acquisition. If the CEO, Ivan Kaufman, steps out and buys more shares, I see a Form 4 with an acquisition, green light. I'm good with that. I am looking at the September $12 or $11 puts. Look at implied volatility, 13-week, 100%, 26-week, we're at 92%. Last IV was 73.5% on this guy. Huge. Nice big fat premium. So I'm looking at that. I'm not concerned. Well, I shouldn't say I'm not concerned. I'm not too concerned about these This is an investigation. It's not a notice. It's an investigation. We're going to read the story that was in the Wall Street Journal a couple of days before this. There is heightened scrutiny and investigation in this whole commercial mortgage industry. And that was initiated, I think, by the GSEs, by Fannie, because they had noticed some issues going on. So listen, back in 2007, 2008, you had mortgage fraud at the residential area everywhere. Well, they're not going to take the chance. They're not going to take the chance that there's widespread fraud going on again. Everybody's going to be looked at. Everybody. And you had a bunch of crappy short stories from low-quality people. Well, to not investigate it after you had that would be, what if there was something there? I mean, how do you even question that after the fact? You're going to be called in front of somebody somewhere and say, you had these reports of something going on and you didn't even look at this company? Why? The questions would be asked. So it's like, well, we kind of got to look at them now, right? So I think that's what this is. So, I tell you here, Thursday night, short July, 14 contracts were exercised, 2,700. I still have 103 July. I still have 103 of the 14 calls that cost me 165. They're like 10 cents now, but I'm not going to close them. I think they'll expire. Look at this spike in volatility. You went from like 31% to where are we? Where did we end? 73.5%. I don't think that it's over in terms of the selling. I think Monday you may get. I don't think you're going to get a recovery, a rally back up to $14, $15. I think that's going to be a while before you get that. More than likely sideways or downward movements over the next week or so until earnings come up, unless you see a Form 4, unless Kaufman puts out, and it has to be the CEO, unless he puts out a Form 4 with a significant buy. So if we see this get to, 1250, 1225, maybe he steps in and buys, I don't know, 100,000 shares. I don't know if he'd buy 100,000 shares. Well, that's still only, 1.2 million? Yeah, you could do that. 100,000, 200,000 shares. It would be nice to see him do that on a Form 4 under the specter of an investigation. Let's look at that story. Okay, this is, I found the story for you on the subreddit, RE Bubble, Real Estate Bubble. It's a Wall Street Journal story, so you are not going to have access to it unless you have a subscription to the Wall Street Journal. This came out earlier in the week, and there isn't much to read, so let's just read through it. Federal prosecutors are ramping up their efforts to root out fraud, often working together with investigators at the Federal Housing Finance Agency, according to court records and people familiar with the matter. While data on the number of open investigations on real estate fraud aren't publicly available, a number of plea deals have been reached in recent months. Since last fall, at least 5 different landlords of properties, mostly apartment buildings, in cities including Cincinnati, Hartford, Connecticut, and Little Rock have pleaded guilty to federal fraud charges. Some allegedly doctored building income statements. Others allegedly faked property sales at inflated prices, all to get bigger loans. These are landlords. ABR is not a landlord. Fannie and Freddie taking action. Meanwhile, government-backed mortgage enterprises Fannie Mae and Freddie Mac are cracking down on questionable practices in their rental apartment lending businesses. Fannie Mae and Freddie Mac effectively blacklisted mortgage broker Meridian Capital Group amid allegations that one of its brokers doctored financial statements to land bigger loans, and have since effectively blacklisted brokers at other firms. So they had noticed something going on, and they're stepping in. So this is now more where our ABR is. Freddie Mac this year changed its underwriting policies to combat fraud. The agency now requires borrowers to submit rent receipts. It also told lenders to inspect more apartments to ensure they are actually occupied. Fannie Mae has been going through loans to weed out those based on sketchy numbers, according to people familiar with the matter. In a May earnings call, Ivan Kaufman, CEO of commercial mortgage lender ABR, listed fraud as one of the unanticipated issues that have created additional stress in the market. Quote, "I think there was a lot of elevated fraud in the industry through the brokerage industry," he said. At the heart of the problem is the way lenders underwrite commercial mortgages. Borrowers typically submit financial statements called T12 that show building income and expenses for the past year. Lenders use these documents to estimate the building's value and calculate how much they are willing to lend, but in most cases they don't audit these statements to verify that the sums listed in the spreadsheets actually flowed in and out of the landlord's accounts. So he is quoted in this story as saying, yeah, fraud is a big issue. So it hardly seems like there's going to be, I think, much of a threat of DOJ or FBI finding fraud within ABR if he's publicly out there saying fraud is a big issue. Bank robbers don't stand up and say bank robbery is something we have to deal with, right? Seems to me. Michigan landlord pleads guilty. A rental apartment complex in Tallahassee, Florida, financed by JP Morgan, made around $296,000 in profit before mortgage payments in 2018, according to Michigan-based landlord Repo Real Estate's internal numbers. But those weren't the numbers lenders saw. Repo told Chetred Group, New York firm that was in talks to buy the property, the profit was much higher, $644,000. Repo arrived at the higher numbers in part by including rent that wasn't actually collected and by leaving out concessions such as free rent periods. An FHFA special agent testified in court. This other one, leaving out a concession, that is just called stabilized NOI. That is what you would do in a forecast. Is you would do that. I read that part and I thought, but it's quite common to stabilize your rents. I mean, it is quite common to do that. So yeah, I don't know. Maybe there's something more in there. Let's see. JP Morgan Chase funded the deal with $481 million loan, which it repackaged into bonds and sold to investors. An appraiser hired by the bank used Roko's inflated numbers to value the Tallahassee property at $5.78 million. JP Morgan Chase declined to comment. So this story appeared in Wall Street Journal earlier in the week. There is investigations going on, and it's not just ABR. The reason is so clear. This was a huge problem in 2006, 2007. Is you had fraud all over the place, and it was so common. Everyone knew about this. You had loans that were called liar loans and ninja loans. Everyone knew how easy it was. In fact, brokers were basically telling you, just lie on your application. No one's going to check it out. Say you make $200,000 a year, no one's going to ask you to verify it. They were called liar loans. Ninja loans, no income, no job. You could still get a mortgage. You just had to lie. It was widespread, and look at the problem it caused. Then things were investigated. Well, not now. Now they're going to be trigger happy. You have Fannie and Freddie saying this stuff is going on. You have the DOJ and the FBI getting involved in this. You have a couple of short reports out there. How can they not look at this company? To not look at them while they're looking at everybody, to not look at them would be the problem. If there was something there, they would have to go on faith that no, this guy's good. Now they're going to look at him. They're going to look at him. And what statement did ABR make? We routinely cooperate with regulatory inquiries and are very confident that we conduct ourselves properly. So you can take it for what it is. I'm not too concerned on this one. I think this selling is not over. I don't think that everyone is going to put the pieces together and say, I'll take it on faith that they're okay. Keep in mind that in that 2006-2007 period, ABR was clean. When everybody was doing it, they were clean. they were clean in all of that. Now they suffered the fallout. They suffered. Their stock price fell to under $1. They had to cancel their dividend. Their industry went into the shitter, but they were clean. I'm going to go on that basis. I'm also going to go on the basis that with all the insider buying, if there was something funny going on, I don't know that you would have seen that insider buying, because those short reports were alleging that going on. And if I see a Form 4, now you're not going to see a sell. If you see a Form 4 sell, that's a huge problem. First of all, their lawyer would tell them straight out, don't you dare. Don't you freaking dare do that. If you see, but they can buy. They can buy. If I see a Form 4 with an A, with an acquisition, that will be all I need. I'll pull the trigger the next day. But I'm looking for a little bit more weakness. I am looking for the September $12 or $11 puts on this one. Their earnings are in August. I think the August expiration would be too soon. They have their conference call in August. Guaranteed question and answer. If we hear nothing, there will be questions. They know there'll be questions, so in their presentation, they are going to address that. Okay, let's talk about Tesla. I got lucky here as well. I got very lucky. That's why when Friday happened with ABR, I started thinking, what's going on? This is so great. I also had my new air conditioning unit installed on Friday. Everything went well, and my house cooled down to 20 degrees by Friday night. My other one, the coolant was low, and you can't replace it. You can only you can't replace the coolant. You can only replace the unit. Everything worked out last week. It was wonderful. Everything's going to fall apart this week. Pretty sure of it. You can't have this much good luck without some bad luck showing up. Here's the good luck I had. As I said earlier, I just couldn't bring myself to buy calls because I didn't believe it. I just couldn't, and it just kept going up, and it was, it was like, I should have done it. And I just decided to buy a put. Thursday, 9:39 a.m. 265 put at 39. Again, I was willing to lose 50,000, so I picked up 13, and I closed at 11.56 at 47 because this news came out during the day. I saw a drop, and I just waited. The delta I had was a 0.51 delta when I originally got these. I think the delta went to like 0.62. It wasn't much of a move, so I didn't really get that. Even though it dropped like 20 some dollars, you don't get that much move on the options. I got an $8 move from 39 to 47, closed at 11.56, which covered off the loss I had from the previous fight, and a nice little profit to walk away with. Friday at 156, I did it again. It sort of went sideways. It recovered and went sideways. I thought, okay, well, it's coming back up. Let's do it again, because nothing has changed. 250s at 36.50. I grabbed 13 of these. Big implied volatility in there. I think, honestly, this whole robo-taxi self-driving thing is a big zero. I don't think that there is anything there. I think it is a car company and a car company, period, and that's it. Somebody said, well, you're ignoring their whole energy business. I'm not ignoring the energy business. It's small. If you valued the energy business as a standalone business, and you gave it a very aggressive multiple, its gross margins are 24.65%, just under 25%. If we think about NVIDIA with 80-point margins, when it was trading 10 times sales, there was the belief that that's a ridiculous multiple of sales, and that's at 80-point margins, 25-point margins. Even if you give it 5 times sales, it's a ridiculous number. Q1 energy storage this year, 1.6 billion. Last year, it was 1.2, 1.3. It's about a 7% year-over-year growth in the energy storage. For Q2, they got a really big customer, so they had a huge delivery of storage. But that's different than getting a bunch of customers every quarter, a growing field. One big one can skew the numbers. Still, their growth rate is nowhere near the 30, 40, 50% that NVIDIA was, and everyone thought 10x was a ridiculous multiple. If you run rate the 1.6 with growth, you might get to 7 billion. 7 billion for the year times 5 is 35 billion. That is a ridiculous valuation for a battery storage in an area where they don't have any real competitive moat or competitive advantage. I mean, anybody who produces batteries can start to do the same. Give it 35 billion. So I'm not ignoring the energy business, just it in no way can justify the rest of the $800 billion, $850 billion valuation. It is a car company with car company margins. GM is more profitable per car. GM's cash flows are much larger than Tesla's cash flows. And they sell more cars, and their growth rate in their EV is higher than Tesla's growth rate in its EV when Tesla first started. So GM is worth what, 50 billion, 55 billion? If we and GM has a robo-taxi on the road. Yes, it had a problem, but it's back on the road. GM already has a robo-taxi. Not a cardboard cutout that it was going to unveil August 8th. And yes, it was a cardboard cutout. Cardboard. That's why when I heard that they delayed it for more time for the prototype, I thought, wow, of course. I mean, what were you going to do? It would have been funny. But that's not really what got me more excited. I get a newsletter from Automotive IQ. Newsletter's kind of neat because they have a bunch of different headlines from the industry, and then they give you a report. Well, this one here was from MI Technology Review. China has selected 20 areas, including Beijing, to participate in its pilot program for vehicle road cloud integration. This aims to build a fully connected system, including roads with detailed sensors, cameras, and transmitters, allowing them to communicate with self-driving vehicles and create a safer environment for connected vehicles in the future. I read this, and in my head I thought, okay, well, that makes Tesla's data worth zero in the future, because I've said this before, you will have full self-driving of all vehicles that are capable of it when the grid is connected. It can't just be 10% of the cars on the road are driving themselves. That's it's almost impossible to get done. But when everything is connected, everything, the roads and all of the vehicles, then that will probably be the future. In which case, what do you need all that data for? So, as an analogy, think about this. You have a retail store. And I drive up to the store, and you got a whole bunch of cameras here looking at the types of vehicles people drive in with. As I walk into the store, you have sensors detecting all of the brand name clothing that I'm wearing. And then based on how I look around your store, you have cameras that are looking at how I look around the store to determine whether or not I am price sensitive. And if I'm not price sensitive, there's a little terminal back here where the salesperson is sitting that'll get a message which will either say service or quality. So you have all of this data that will determine if I'm price sensitive or not. And if I'm not, they know to come over to me and start showing me product and talking to me about the service they provide and the quality of the product I'm buying without paying attention to the price. So you've invested a lot of money in this to be able to tell within a couple of minutes of a customer walking in the store what sales approach you should take to that customer. Great. Now, what if, when I walked in the store, I had a sensor on me that communicated with you that I'm not price sensitive right away? I'm not price sensitive. How much is all that algorithm worth to you now? If customers are going to walk in the store with sensors on them and just tell you the outcome of what your regression would have told you, your data is worth zero. So let's go back to this story. This is a pilot program. So it's, deploying it is years in the future, but I want you to think about if you have a fully connected system, the roads have sensors, cameras, transmitters, every other vehicle has sensors, the pedestrians walking down the street have their phone on pedestrian mode. You've got sensors in a lot of places. Previous, your car had to figure everything out. Is that a pedestrian? Is that a street light? Is it a red, green, or yellow light? Is that a vehicle? How fast is that vehicle going? But now everything is just going to tell you what it is. How much is all that data worth? All that data that Tesla's so very proud of, how much is that data going to be worth in the future? Zero. So no, if to get these vehicles the way Musk sees them, that I buy a vehicle and then I can subscribe it into this fleet of robo-taxis, and I'm watching TV one night and my car just leaves my driveway and goes to pick it. That's fantasy. That will be in place only when the grid is smart. And when the grid is smart, I don't need your data. So I don't know that their data has any value other than slowly improving their level 2 driving. They do not have a level 4 vehicle. No regulator has come forward and said, yes, we do have an application. Of the regulators, of the geofenced areas where you can run a level 4 vehicle, they have not applied for one at all. They don't have one. So that is why I feel comfortable with the puts. I felt comfortable with the short, but until everyone recognizes the price and the fundamentals are divorced, it's not going to work. Which means my losses would increase and increase and increase. By buying the puts, the most I can lose now is 50. And I'm comfortable with that. If I lose 50 on it, I lose 50. But I've got the January 2025 250 puts. Let's look at the peso and EWW. You can see the peso really gaining strength here, and especially into the close of the week. US dollar weakened, so that does some of the heavy lifting for the peso, but that was your election result, which seemed like an overreaction. I was looking for the 19 to 1950 range. If it got in here, I would have gone long the peso. I got a little bit greedy waiting for that. Didn't happen, and we're at 17.6. EWW back up at 61.74 as a proxy to being long the peso. I sold the 55 puts on EWW at I got $1 for them. They expire this coming Friday. 55 is down here. We're up here. I'm very far away from any gamma risk on this one, so I'm just going to leave them open. As the peso strengthens, since EWW is in US dollars, the value of EWW increases. So you would expect that these two charts would be almost mirror images of each other. Here's the election results, and here is the aftermath, much as we see up here. I'm not confident that we'll get to 19 on the peso. So I have no position on the peso right now. I do feel over the next few years that it is a stronger peso we'll be looking at. I don't think the foreign direct investment story is over in Mexico at all. So I think if I saw at this point 18, probably the 18 to 1850 range, if we got back in here, I'd be thinking about a long position in the peso, or if I didn't want to take any currency risk, selling puts on EWW. 18 to 1850 would probably be a signal to sell maybe 40 delta, or if I'm more conservative, 30 delta puts on EWW. Okay, SPY on July 10th, this past week, we hit another all-time high, 561.05, and I think on Bloomberg they had mentioned that was the 34th all-time high this year. Forward 4-quarter operating earnings 261.17, down from 261.39 from LSEG. SPGlobal 258.36, down from 258.63. Closing XPX 56.15 gives us a 21.6 times forward operating earnings. Week before was 21.41. Surprise factor from companies reporting this quarter, 3.6. Last quarter was 8%. The upside surprise 3.6%. For next 12 months, using operating earnings 21.6 times, using expected EPS 23.7, trailing using operating earnings is 26 times, and trailing using EPS is 29.34 times trailing earnings. 50-day moving average 535.11, which is 4.4% down. 200-day moving average is 490, that's 12.4. A correction, a typical standard 10% correction, would bring us to 503.99. Based on what happened on Thursday, you had huge tech sell-off and a huge small cap buying, a big rotation going on, and then Thursday you had more small cap buying, but a recovery in the sell-off that you had from Thursday. So I don't know what to expect from that. Also, let's talk about the shooting Trump's ear. I don't think that the guy was aiming for his ear. If he was, that was one hell of a shot. I think he was looking to take the guy out. At least that was the there were some posts that he made that's sort of what he was leaning to do. He was looking to kill the guy, and his ear got clipped. I don't know if that's going to rattle markets, and markets are going to go down. The discussion today, out of almost every headline I've read, is there's that one picture of him being surrounded by his Secret Service and his fist up in the air, blood on his face, and the American flag hanging in the background. With the general consensus out there is this, but all but solidified a victory for him in November. It's pretty much a done deal. So on the opening of Globex tonight, are we going to see a massive sell-off in the markets because of heightened risk? Or are we going to see a rally on the Trump trade? I don't know. He's okay. I think it would be a different story if the bullet had actually done some real damage. I think you're going to see red ink for sure. But he's okay. But it's still a shooting. You still have this increased risk to the point where you have an attempted assassination. But he's okay, and those pictures, the pictures that will be going around there, are so bloody defiant and patriotic that's I don't know. How do you beat that image if you're Joe Biden at this point? It looked like he was going to lose. It pretty much is almost in the bag that he's going to lose with this one now. I don't know what to expect. If I had to make a bet right now, it would be a coin flip. I don't know, but we do have that to look forward to. If there is any inkling of a correction, if there were fund managers this weekend saying now's the time, we should rotate now, let's take profit now. Is this enough to cancel their plans, or is this enough to say, well, this lines up well with a correction? I don't know. But 4.4% wouldn't be unrealistic considering the run that you've had in this market, and 34 all-time highs with earnings that don't seem to be supporting the same increase in the multiple. IWM week over week, this is for the Russell 2000, up 6.11%. SPX was up almost 1% week over week. IWM up 6%. IJR, which is the S&P 600 small cap, the profitable small cap, up 5.46%. Right? Just kicking it. I think that's how you crazy kids talk these days in short little things like that. Just kicking it. Look at the mess we have here. Seriously. LSEG, 46 companies are reporting this week. SPGlobal says 38. Sector Spider, I guess not wanting to look like everyone else, says there's 44. Come on, man. Anyways, we'll look at LSEG in terms of who's reporting this week. There's some interesting ones. Tesla isn't reporting till next week. It's next Tuesday after the close. That is the 23rd. I think this week, the big one we have this week in tech is Netflix. And in the housing market, we have DHI. Okay, Monday, we have BlackRock and Goldman Sachs, both before the bell. I don't know that there's going to be much talk about this Monday morning on Bloomberg. I think we know what the topic is going to be. That will dominate all day long. Going into Tuesday, Bank of America. We still have the financials, and then we'll get into the regionals later in the week. Bank of America, Progressive, Morgan Stanley, PNC, Charles Schwab, State Street, United Health Group muscling its way into here, Omicron, and JB Hunt for some transportation, some trucking services. Wednesday, Citizens, Johnson & Johnson, Northern Trust, Prologis. They're a large REIT, a large industrial REIT. U.S. Bancorp, Crown Castle, Discover, Kinder Morgan, United Airlines. I wonder if they'll follow Delta on the way down, United Airlines. And let's see how Vegas is doing, Las Vegas Sands. Going into Thursday, Abbott Labs, Blackstone, D.R. Horton. There they are, 8:30 before the bell. Domino's, KeyCorp, M&T, Snap-on, Textron, Intuitive Surgical, Netflix. There's a big one after the bell. And going into Friday, Schlumberger. Let's see if they can do a little bit better. Schlumberger, American Express, Fifth Third Bank, Halliburton, Huntington. Huntington has not done well over the last couple of years. Regions and Travelers. So you get some of the regionals near the end of the week. Next week, more regionals and big tech. Next week, a big tech week. So we're still heavy on financials, going from the nationals to the regionals into the end of the week, and regionals carrying over into early next week. And that's it for this week. I will see you on the live at 7 p.m.